What if I told you that most traders are falling into a trap, losing money because they don't understand one critical concept? Have you ever wondered why certain levels act like magnets, pulling the market back, trapping traders, and then launching in the opposite direction? Welcome to the ultimate guide to breaker blocks, an advanced yet powerful concept that can transform the way you trade. By the end of this video, you'll not only understand what breaker blocks are, but also know how to identify, trade, and maximize their potential. Let's dive in. What exactly is a breaker block? In simple terms, a breaker block is a zone where price reverses sharply after trapping traders, or a failed order block. Breaker blocks are formed when the market breaks a key level, like a previous high or low, but instead of continuing with that momentum, it reverses sharply before moving in its breakout direction. This reversal traps breakout traders and signals a potential shift in market sentiment. Understanding breaker blocks can help you identify high-probability trade setups, especially in markets where manipulation often occurs to trigger stop losses and collect liquidity. Steps in identifying a breaker block. First, identify a valid break of structure or liquidity sweep. A breaker block often originates from a failed order block. To identify an order block, there should be a valid break of structure in the market's current direction. This is usually accompanied by a surge in volume, which confirms the presence of smart money. The break of structure also acts as a liquidity sweep, targeting retail traders who place stop losses at obvious levels like recent highs or lows trading against the trend. Next, locate the order block zone and wait for retracement. An order block is a zone where institutional traders previously entered large positions. Retail traders often assume the price will respect this zone and jump in prematurely. However, instead of holding, the market aggressively breaks through the order block. This traps retail traders and flips the order block into a breaker block. The market uses the liquidity that is triggered stop losses around the order block to fuel its next move in the opposite direction. Once the breaker block is formed, it becomes a new zone of interest for smart money. Finally, wait for a pullback and confirmation. Patience is essential when trading breaker blocks. After the breaker block forms, don't enter immediately. Wait for the price to pull back into the zone. Look for signs of confirmation, such as rejection wicks, engulfing candlesticks, volume spikes. These signals indicate that the zone is holding strong. Only enter when there is clear intent from the market, ensuring you're trading alongside smart money. Key criteria for high-probability breaker block setups. First, large volume. Volume is essential for confirming breaker blocks. High volume during the breakout, lower volume during the reversal, and moderate volume during the retest form a strong setup. This indicates smart money involvement, making the breaker block more dependable. Next, higher time frame trend alignment. Trading in line with the higher time frame trend greatly boosts your success rate. For instance, in a bullish trend, target breaker blocks at support zones. In a bearish trend, seek breaker blocks at resistance zones. This alignment ensures you're trading with the overall market momentum. Then, market inefficiency alignment. When a breaker block aligns with market inefficiency, such as price imbalances or fair value gaps, it becomes a stronger setup, and price often retraces to fill these inefficiencies, creating a high probability opportunity to trade the breaker block. Finally, order block alignment. If a breaker block aligns with a valid order block, the setup becomes even more robust. Since order blocks represent areas of trading activity, this alignment increases the likelihood of a successful trade. Moving on, let's apply this concept to a real chart. Example, gold, USD. Here, the market is in a bullish trend, forming higher highs and higher lows. Identify an order block and mark the zone. As the market approaches this level, many retail traders expect the price to reverse here. However, the market breaks through the order block, triggering stop losses of traders who entered without confirmation. Next steps. On closer observation of the breakout, the market created an imbalance while breaking through the order block. Mark out the imbalance and wait for the price to retrace. Once the price retraces to the breaker block zone, watch for a rejection candle or other confirmation signal. Lower time frame analysis for entry. Let's switch to a lower time frame for entry. Here, on the 15-minute time frame, the market forms an evening star candlestick pattern, a strong reversal signal, at the breaker block and FVG zone. Set a limit order at 50% of the evening star pattern to reduce the risk ratio, and place the stop loss a few pips above the pattern. Target the next support zone on the higher time frame or aim for a 1.3 risk to reward ratio. A quick piece of advice: when in an open trade, always watch and manage your trades to secure partials when necessary and use a trailing stop to capture more profits. Eventually, our take profit got hit. For more details on trading the evening star pattern, check out our previous video. Final tips for trading breaker blocks. Avoid entering too early. Wait for confirmation. Always trade in alignment with the higher time frame trend. Avoid risking too much on a single trade. If the stop loss is too large, set a limit order and wait for the market to come to you. If the market doesn't trigger your limit, let it be. It's better than losing too much on one trade. Not every setup is worth trading, so stay disciplined and selective. If you learned anything from this video, like and follow for more insightful content. If you have any questions, comment below. If you have any topics you want us to cover next, don't hesitate to drop them in the comment section. Happy trading!